Greetings and welcome to the latest event in the Gies College of Business Teaching and Learning webinar series. I'm Amanda Brantner, Senior Associate Director in Online Programs here at Gies College of Business at the University of Illinois. I look forward to spending the next hour with you. Our faculty experts have developed this series of webinars to address some of the pressing issues businesses face today, from the economic impact of COVID-19 to cybersecurity and ethics. These webinars enable you to be better prepared to succeed and thrive through any number of challenges. Before we get started with IPO-ing during a pandemic, a financial reporting perspective with Professor Nerissa Brown, I want to cover a few brief housekeeping items related to the Q&A portion of today's session. Please submit all of your questions via the Zoom Q&A feature. Your questions will be submitted publicly for the broad audience to see. In order to develop consensus around questions, please use upvoting. The upvote thumb is located next to the question in the Q&A window. I look forward to bringing the top questions to Professor Brown following the presentation. Any general housekeeping questions you might have will be answered in text by the Gies team working in the background. It's now my privilege to introduce today's presenter, Professor Nerissa Brown. Nerissa teaches financial reporting here at the University of Illinois, and she is also the academic director of our Bachelor's of Accounting and Master of Accounting Science programs. She's a nationally recognized expert on financial reporting and IPOs. She's become a go-to source from publications like the Wall Street Journal, Fortune, and Bloomberg when they need expert commentary on a financial reporting topic. She's also served on the editorial board for several top accounting journals. I hope each of you is as excited as I am to hear what she has to share. Please join me in welcoming Professor Nerissa Brown.
Thank you, Amanda, and hi everyone. Honored to be here and looking forward to our discussion. To kick it off, I'm going to go ahead and share my slides. So Amanda, are we good? Okay, great.
Hey, Nerissa, we're good. We're seeing that your network's having a little bit of issues right now. One way you can handle that is by turning off your video. If you just hit stop video, we'll still see your slides and still be able to hear you. Yep.
Okay. All right, well, thank you everyone for being here. Let me just walk you through today's agenda. So as Amanda mentioned, we're going to be talking about initial public offerings during the COVID-19 pandemic and the resurgence of the stock market. For today's agenda, I will first start by discussing general stock market and IPO trends during 2020. I will then talk about some basics about IPOs. For example, what is an IPO? What are the main types of IPOs we are currently seeing in the marketplace? And then we're going to dig deeper into two big tech unicorns in the gig economy that launched an IPO in 2020. And those two are Airbnb and Doordash. And they went public in mid-December. And then I'm going to turn it back to Amanda to wrap up for Q&A. So my next slide has a couple of headlines that were featured in news articles coming from the Wall Street Journal as well as the Washington Post. Of course, it seems like an oxymoron to refer to 2020 as the roaring 20s, given that we have the COVID-19 pandemic that has pretty much turned much of our economy and our daily lives upside down. But these news headlines, especially the two that I have here on the slide, talk specifically about the stock market's resurgence and the fact that despite the surges in the coronavirus and the fact that we have still massive unemployment, the stock market itself really resurged during 2020 and ended at record highs in 2020 as well. The other headline talks about a specific type of IPOs related to special purpose acquisition companies, and the fact that those types of IPOs actually lifted the Wall Street, the way how the stock market ended in 2020. And that's something that we're going to touch on in today's presentation. So let's start talking about this by looking at two very interesting graphics, again, coming from that first Washington Post article that I mentioned. As we can see in the top graphic, we do have the stock market, and here the index that is represented is the S&P 500, which ended at a positive 16.3% for the year compared to where it started in January 1st. However, on the bottom graphic, we can actually see that due to the pandemic, the shutdowns that we all witnessed, unemployment was pretty much staggering throughout 2020. Things have gotten better, but the unemployment rate as of right now is still 2 times higher than before we entered into the pandemic. The unemployment rate right now is 16.7%. It went as high as 20% during 2020. So these two graphics just kind of shows a dichotomy between what is happening on Main Street versus what is happening on Wall Street. Another thing to note during 2020 is that household savings actually increased by more than $1 trillion in 2020. Many of you are currently at home. We're saving quite a bit because we're not traveling, we're not eating out, we're not spending like we used to. And therefore, there is a lot of pent-up cash, you would say, sitting around in our economy, more at the tail end of the distribution when it comes to households. And so there is that type of pent-up demand for investment vehicles, especially superstar stocks that you can invest that cash in and earn a great return. Now, bear in mind when it comes to the stock market and stock prices, those prices reflect several things. So throughout 2020, people kept asking the question, well, why is the stock market booming when unemployment is so high? Bear in mind that the stock market reflects investors' expectations about future economic performance. And so many investors do expect us to come out of the pandemic, hopefully sometime in 2020. And it is predicted that unemployment will return to pre-pandemic levels sometime in 2021. Of course, it's left to see how we do on that end. Also, there is generally market euphoria with respect to companies that have demonstrated that they're fairly resilient to the pandemic, or companies whose growth was actually fueled by the pandemic. And one of the IPOs that we're going to look at, both IPOs that we're going to look at, fits in this category. And as I noted before, the other thing that the stock market prices are reflecting is the fact that there is idle cash, there is idle savings in search of investment returns. And then the last thing I want to point out, during 2020, we did have quite a few novice investors engaging in day trading while being stuck at home. And they tend to trade in stocks that they're fairly familiar with. This graphic just also relates to the top graphic from the previous slide, just showing a little bit more detail about the resurgence of the stock market. We did see that V-shaped recovery, as you notice here, around March and April. There was a huge drop in stock prices, and we've eventually re-emerged out of that. And by the end of December, the S&P 500 closed at a record high. And so that V-shaped recovery that was predicted at the beginning of 2020, we do see it when we look at stock market indices. One thing to note here too is, as it's noted here, May 8th, unemployment did go up to 14.7%. By the time we got to July, real GDP fell to 33%. Notice that these statistics are typically lagging indicators. So the unemployment that we actually see here, the statistics that's posted by May 8th, refers to unemployment that happened several weeks before. And again, as I noted, stock prices are future or oriented. Now turning to the IPO front, here we see that the resurgence in the stock market also fueled a record number of IPOs coming to market in 2020 and actually surpassing the IPO volume we saw in 2019. This graphic here plots IPO volume from 2003 all the way to 2020. As you can see here, compared to 2019 and even 2018, our IPO volume is significantly higher in 2020. In the graphic, I have two types of IPOs, and we're going to talk a little bit more about the specific types of IPOs. The blue bar represents traditional IPOs that go through the underwriting process. Most of these IPOs are your typical operating companies. And on the orange bar, I have those special purpose acquisition companies. Another way to refer to these types of IPOs are their blank check companies. They have no operations. Their main purpose is to launch an IPO and in the next year or two, find a company to merge with or to acquire. And by default, that private company that they have merged with or acquired will automatically be public. And so that's one thing that has been discussed quite a lot in the business media, the rise regarding blank check IPOs in 2020. The bottom of the graphic shows something very interesting. When we get to 2020, I have here plotted the average first day return for IPOs, and that's the change in the company's stock price on the very first day traded. And so the average first day return shows us pretty much the jump in stock price as these firms pretty much left the gate when they launched on the stock exchanges. Notice in 2020, average first day return is significantly high at 40%. So the IPOs that did go live through 2020, because of that pent-up demand, return was very high on that first day of trading. However, when we look at our blank check companies, the first day return for these companies are very marginal, averaging out in 2020 at less than 2%. And it can be because, as noted before, these companies, they have no operations, they have no revenue. And so even though they're fueling the IPO market in 2020, the returns that they gain are very marginal. So what are the main drivers for the IPO boom in 2020? I have three here. The first one is related to the fact that we had several tech unicorns continue with IPOs in 2020. And by unicorns, we mean private companies valued at $1 billion or more. We had a lot of other smaller IPOs in the pharma and life sciences industry. So a lot of small biotech firms did come to market. And of course, with the rush towards getting a coronavirus vaccine, it's very understandable why we had, a significant number of biotech firms doing IPOs. And again, here, the third reason, as I noted, is our blank check companies. The graphic on the other side of the chart just demonstrates the fact that on average, the returns being earned on IPO firms is significantly higher compared to even the S&P 500, the NASDAQ, and again, significantly higher when we look at traditional IPOs versus or blank check companies. However, a lot of the companies that did come to market were much more on the tail end when it comes to negative earnings compared to IPOs that we've seen in the past. So this graphic just shows IPO volume, again, from 2003 to 2020. And the line plot just shows, on average, what's the percentage of IPOs that launch that had negative earnings. So in 2020, roughly 80% of the IPOs that went live in 2020 had no positive income. They were all generating losses. So here is just a plot of several of the top, I would say 13 IPOs that launched between 2020 and up to, I have January, up to current date in January 2021. So we had a couple biggish IPOs that did launch right after January 1st. In, the darkest blue dots, this is where we have our big tech unicorns. We have Airbnb, we have Doordash, which came to market in mid or early to mid December. We also have Snowflake, which is a company that specializes in cloud-based data warehousing. And that IPO came to market in September. In January, the IPOs that are very recognizable that came to market, we have Poshmark in the retail industry. We have a firm that does consumer credit, and we have Petco with pet supplies. If you notice here, many of the entities that launched IPOs are in industries that you would say are fairly pandemic resilient, or they somehow benefited as well from the pandemic. So for example, we have Warner in music and industry, again, Petco in pet supplies. We have GoodRx, which has a telemedicine platform and a mobile prescription app. We have Palantir, which deals in cybersecurity and data intelligence. And again, we have Affirm and also Rocket companies, which launched in August, which deals with loans, mortgages, and consumer credit. Now that we have seen, what IPO volume looked like in 2020 and the types of IPOs that came to market in 2020, let me turn your attention now to the basics of what is an IPO, what are the different types of IPOs we see in the market, and then we'll touch on in more detail Airbnb and Doordash. So I have here just a general definition of what is an IPO. It's essentially the process of offering shares of a private company to the public in a new stock issuance. It allows a company to raise capital from public investors, and an IPO is also considered an exit strategy for founders, venture capitalists, as well as angel investors. I wanted to note here that this exit strategy can be seen by the fact that a good chunk of the shares that are sold in IPOs are secondary shares, meaning shares that are already owned by private or insider investors, so current investors of the private entity. And so an IPO represents or presents them the opportunity to actually sell their shares to the public and then realize a return on their investment. However, sometimes it can be seen as a bad signal if a lot of your IPO shares that are being offered to the public, if a good chunk or a very high proportion of those shares are coming from exiting investors. Typically, when we see that, we say, well, why are so many founders and early investors exiting this firm? Do they know something that we don't know? And so, research has shown that when an overly high proportion of shares that are being offered in the IPO are from exiting investors, the future performance of the IPO firm is lower. Now, here are the three main types of IPOs that I'm going to touch on. We have IPOs that are termed book built. These are IPOs that have an underwriter that brokers the shares. We also have a new type of IPO that is slowly gaining traction in the marketplace. These IPOs do not go through the underwriting process. They directly list on the exchange and start trading on a particular date, and the price they fetch is dependent on that initial price that investors are willing to pay for the shares on the very first day of trading. And I'm going to touch again on or special purpose acquisition companies, or SPACs, or blank check companies as well. So the underwriting process for book built IPOs is fairly lengthy. It can take 6 months to a year to complete an IPO that has an underwriter. And pretty much that underwriter, as I noted before, acts as a broker. It represents the IPO firm and engages in the process of finding investors, mainly institutional investors who are willing to purchase the shares. That underwriter also gauges the demand for the shares and at what price. So through the underwriting process, the actual price for the shares will emerge by the time the IPO goes live. Usually at the very beginning, which is the very first step that you select an underwriter. Most IPOs will have, most private companies who want to do an IPO, they'll have an idea of the price range that they want to offer the shares at. And during the underwriting process, as the company goes on a roadshow, does presentations about the company, meet with investors and analysts, etc., you start to gain a sense of the demand for the shares at a particular price. Sometimes that price can be within the initial range, and sometimes it can be higher. So during that process, if you follow an IPO during the underwriting process and follow news articles, you will typically hear news about, oh, IPO X is now pricing out at X dollars. This process also has regulatory filings, which also can lengthen the amount of time it takes to complete an IPO. All IPOs, they have to register with the Securities and Exchange Commission. They have to file what is called a Form S-1 registration statement. They'll do a draft prospectus, and that draft is called a red herring prospectus. That prospectus, the actual price that the shares will be offered at is usually blank because we're still in the pricing stage. Sometimes the number of shares that are going to be offered sometimes is blank. But that draft prospectus tells you a lot about the company. It tells you what is their business model. It tells you what is their financial performance over the last 3 years. Those financial statements that are in the prospectus also needs to be audited, and it gives managers of those private entities a chance to talk about the future prospects of the firm. Now, this draft prospectus, when it's filed with the SEC, will go through a revision process. The SEC will send back comment letters on things in the prospectus that needs to be revised, financial numbers that potentially might be misleading and need to be calculated. So there are several rounds that companies go through back and forth with the SEC in that comment letter process. And once the SEC gives the green light, they'll give you a notice of effectiveness, and then the final prospectus is issued, and pretty much the shares will start trading, by that next day. Another thing to note here is step 4. The underwriter also has a job of stabilizing the share price once the IPO goes live. And so that one role of the of the underwriter is to help to stabilize the share price in the days right after the IPO. So if the price falters, or if the price of the shares is a little bit shaky, the underwriter can actually step in and buy shares on the open market, but at a price that is no higher than the offer price. And so the underwriters, one of their roles is to support the IPO in the first few days once it goes live. And then after that, the company will transition into a fully publicly traded entity where you don't have an underwriter like supporting the price. A direct listing IPO doesn't have that cushion when it comes to the underwriting process. It's very attractive for companies not to use an IPO if they are a very well-known brand and they're very confident that once the shares list and starts trading, then they'll fetch a good price and they don't need an underwriter to stabilize the price itself. Now, in 2020, about 3 firms did a direct listing IPO. One of them is Palantir, which I mentioned before, that engages in cybersecurity and data intelligence. One of the biggest companies that did a direct listing IPO 2 years ago, back in 2018, was Spotify. And of course, they're a very well-known brand, and their direct listing IPO went off fine. Those regulatory filings are still required. One benefit of doing a direct listing IPO is that you capture capital based on the current market demand on that first day of trading. So you might enter trading on the first day, you might leave the gate at a price that is higher than what you would have set the IPO offer price to if you went through the underwriting process. However, that does carry some risk, because if the market demand isn't exactly what you envision and the initial price is a little bit lower, then you kind of lose out there. The benefit of the underwriting process is during that process, you have investors that do commit to purchasing the shares at X price. Or blank check companies, those SPACs, essentially, again, these entities can engage in an IPO just like a regular entity. They're literally a shell company. They have typically a sponsor investor or a hedge fund that takes that blank check company public in an IPO. And that blank check company is typically funded with cash. And you can think of it as a cash holding shell. It has no operations. And the main purpose is to acquire or merge with a private company, typically within 2 years. And that's where the term special purpose acquisition companies comes from, because the main purpose of those shell companies is to just sit there and try to find a good deal that you can purchase. And by default, that private company will become public. That private company doesn't necessarily need to go through their own IPO process, because the shell company has already done that. So that's one of the key benefits of these types of IPOs. However, as we have traditionally seen, these IPOs, their first year returns are pretty low. The companies that they do tend to acquire or merge with in the future tend not to do that great. And so even though the investors, the sponsor investors, and the hedge funds that invest in these type of companies, even though they do make a return, there's really some debate about how this affects investors that do stay with these entities once they acquire a private company. Typically, we see that once these entities do acquire that private company, their performance in the future sometimes tends to be negative, and the investors that tend to stay in potentially are hurt. And so that's kind of one downside of this boom in blank check company IPOs. And so it will be interesting to see if this trend continues in the future. Now let's talk about our two big pandemic IPOs. And these are pretty fun companies. We have Airbnb and we have Doordash. And I'm pretty sure that most of you on the presentation are familiar with these two companies. So Airbnb and Doordash, they're both entities in what we call the gig economy. Airbnb deals with matching hosts with guests, and the hosts pretty much have the guests stay in their private residence or any private home or apartment that they own. And Airbnb generates revenue by charging fees to both sides. Doordash, also a part of the gig economy, their business model, and we talk a little bit more about this. Their business model is, to match merchants, mainly in the restaurant industry, with consumers and a third party, which they call dashers, which are your drivers. And so consumers will order meals. They are a food delivery platform from restaurants, and dashers will, pick up those meals and transport them to customers. And so DoorDash, their main model is in logistics. And when we look into their prospectus, that's pretty much how they brand themselves. They are a food delivery logistics platform. So both companies went through their IPO pretty much 2 days apart. DoorDash went live on December 9th, Airbnb on December 11th. DoorDash was listed on the New York Stock Exchange, Airbnb on NASDAQ. NASDAQ is a stock exchange that traditionally has smaller companies. And you can see that here, the market cap for both entities, the deal size was about the same, 3.37 billion for DoorDash and 3.51 billion for Airbnb. Notice that the offer price for Airbnb is, almost half that, or not really half, but about 2/3 of the offer price for DoorDash at 102. The market cap currently for both companies are also significantly different. So if we look at DoorDash, which is plotted on the blue line, they went live at 102 offer price. Over the last few weeks, their stock price have trended downwards. But as we, pretty much crossed over into closer to the holidays and into the new year, the stock has reemerged. The current return overall for DoorDash compared to the price that they started at is 4.6%. That's their return. Airbnb, of course, has done more smashingly. So they also had a downtick in their share price after doing the IPO. And this is typical. IPOs will usually start off really good, and over those next few days, they'll trend a little bit more downwards. This peak here is kind of pretty much right around the holidays. And, you know, they had a bit of a downturn in their stock price, and it has, you know, gone up quite significantly. Their overall return since launching on the December 11th is almost 31%. So both stocks have been doing well. And in their prospectus, which we'll talk a little bit more about, they talk about in their prospectus the fact that they're either resilient to the pandemic or their growth has been fueled by the pandemic. So let's touch a little bit more about the prospectus. And so for Airbnb, I just wanted to point out the timeline of how long it took for them to go through the IPO process and the underwriting process. So they filed their draft registration statement, their draft prospectus, on August 19th. So pretty late in the summer. You know, the economy had opened back up, you know, not fully, but, you know, most of us in the summer were, you know, still a little bit optimistic. And then by the time we got a little bit closer to September, we saw a little more uptick in coronavirus cases. They did go through around 5 rounds of comment letters from the SEC related to their draft prospectus. The first of which, their first comment letter, they got on September 17th. Their notice of effectiveness, meaning that they had the green light to now launch, was December 9th. And then they started trading on December 11th, and we have that final prospectus. Now in the prospectus, I mean, it's a very lengthy document, so of course I couldn't put everything on one slide, but in a prospectus, you're going to see different parts, and a lot of what you'll see in the prospectus goes beyond the financials. It's really an opportunity for the company to share a lot about their business model, their operations, their values, you know, what's important to them, and to share that to the public before doing an IPO. So related to their business model, they are a home sharing platform that connects hosts with travelers. They generate revenue from fees, both from the hosts and the guests. On average, their fees range about 15%. In the prospectus, they talk about how are they going to use the capital that they're going to gain from being publicly traded. How are they going to use the proceeds from the IPO? And this is pretty standard in a prospectus. Here, most companies will just talk about the fact that they're going to be using the cash for operations, acquisitions, and investments. In a lot of cases, they have employees that they've given stock awards, or another term for them is restricted stock units. And usually you're going to use the return, the proceeds to settle these restricted stock awards with employees. Now, in the prospectus, there are lengthy discussions about a company's risk factors, and that's the main purpose of a prospectus. Not just to tell the investing public all the great things about the company, but also every risk that you might potentially face, so that investors are aware of what they're getting into when they invest in that stock. So of course, for both of these companies that we're going to talk about, Airbnb, front and center, COVID-19, the pandemic constituted a major part of their discussion related to their risk factors. They also talk about the ability to attract hosts and guests and to retain them long-term, you know, the ability to have, to retain your hosts and guests, and the ability to make sure that they stay with the platform long-term. They also talk about the fact that they have been generating quite a few losses over the last few years. They have yet to turn a profit. And so they talk about what we call going concern risk, the fact that they have to say to the public, hey, we have yet to turn a profit. It's unclear when that will happen. However, of course, they do expect to become profitable in the future. There's also a lot of disclosures related to a company's financial performance. The main reason being that when you invest in a company, your goal as an investor is to generate a return, and that return is dependent on the company's performance. So as you see here, for Airbnb, they generated quite a large amount of losses just in the 9 months, ending September 30th, 2020. A lot of these losses are related to the pandemic. They also report an adjusted EBITDA number, and this is considered to be a non-GAAP number for regulatory purposes. This number does not abide by generally accepted accounting principles. However, companies are allowed to demonstrate their financial performance measures in alternative ways if they feel that the standard accounting metric does not adequately tell the investing public about their financial performance. So this metric that Airbnb disclosed pretty much took the net loss of 697 million. It took out common expenses such as interest expenses, taxes, depreciation and amortization. They also took out expenses related to stock compensation, which is fairly common that we see in IPOs. They also talk about the fact that they had to do some restructuring during 2020 related to the pandemic, and they took out the charges related to those. So that net loss of almost 700 million, once they made their adjustments, still a loss, but significantly smaller at only 230 million. Revenue in 2020 was a big problem for Airbnb, simply because of the fact that with the shutdowns and the restrictions in travel, they did have just a ton of cancellations with travelers. And so they had a 32% drop in revenue as of September 30th, 2020, compared to the same period in 2019. However, one big takeaway from their prospectus is that they talk about the fact that even though they did see a significant dive in bookings, so when travelers book with hosts, they actually re-emerged out of that fairly quickly. And you can see that in this chart here. By the time we get to April, which is where a lot of states really started shutting down between March and April, you notice just a significant dive in bookings. And as we got through the summer, once states started to reopen, bookings increased again. So in their prospectus, they talk about the fact that during the pandemic, the whole notion of work from home actually helped them, because then you could actually work from any home. So you still had people making bookings to travel and maybe still, act cautiously and quarantine, but they could do that from, some other place and not necessarily from their home. The fact that travelers opted to stay closer to home, travelers opted to drive instead of flying, traveling, also helped Airbnb as well with respect to the big takeaway from their prospectus. They also talk about the fact that they have repeat revenues. And so one thing that I found interesting from their prospectus is the fact that they can track how long a host or a guest has actually stayed with the platform, and how likely those hosts and guests are to continue on with the platform. So if you notice, for hosts, if you are interested in, let's say, offering your home or apartment to travelers on the Airbnb platform, the statistics that they provide actually shows that most people, most hosts, when they do that, they tend to stay fairly long term with the platform. It's like once we do it, then and start generating revenue from that end, we're more likely to keep doing it. Guests, on the other hand, the retention of guests is significantly lower, but still, once a guest has stayed at an Airbnb property once, then over the next few years, they are at least close to halfway more likely to stay at another Airbnb property. So that's pretty interesting from their prospectus. Now I'll wrap up just talking about DoorDash. Again, they are, a platform that matches merchants and the customers with drivers or dashers. So they are the Uber of the food delivery industry. Now they took a little bit longer to file their prospectus. As you notice, they filed their draft registration all the way in February 2nd, so well before the US declared a national emergency in the middle of March. Now, the process with respect to their prospectus, they had their first comment letter from the SEC on March 12th, but they took their time in updating the prospectus. And you can see that because DoorDash did decide to wait it out a little bit before doing their IPO. However, they did follow suit with a lot of other entities and continued with their IPO much later in the year. So they got their notice of effectiveness December 8th, and they started trading December 9th. So again, their business model, they generate revenues from consumers and merchants, fees roughly 15%. Their use of proceeds is pretty much the same. General purpose, business purposes, acquisitions, settlement of stock awards. Another interesting thing that I saw in their prospectus related to the use of proceeds is that they, as a company, have pledged to give back $200 million back to their community. And so they're going to use some of these proceeds for that. Going concern risks is a problem here. COVID-19 risks, they discussed quite a bit. The ability to retain consumers and merchants on the platform. And for DoorDash, considering that they're in California and this was on the ballot, whether gig economy workers should be reclassified as employees, presented itself as a significant risk. Net loss for them for the 9 months was they actually made a profit for the 9 months ending September 30th, 2020. So this should be a profit. Once they adjusted that, excluding stock compensation and restructurings, their adjusted EBITDA is 95 million. Year over year revenue actually increased 3 times for DoorDash, and it's strictly being fueled by the pandemic and the fact that everyone is ordering meals using DoorDash and other types of food delivery services versus going into restaurants. So the other big takeaway here is that their growth in 2020 was largely fueled by the pandemic, and these graphics pretty much represents that. Also, they talk about repeat consumer revenues. So for both of these entities, given the fact that they generate revenues by charging different parties fees, they need to make sure that they're retaining customers And you can see here for DoorDash, when they look at their different cohorts from 2016 to 2018, the amount of revenue that they generate is still on average within that 15% range. Now, the last thing I'll wrap up with about these two companies, if anybody is interested in learning more about them, you can always go to Yahoo Finance and dig a little bit deeper into the street expectations, the financials related to these two entities. Street expectations about these two entities are still pretty strong. Their ratings are somewhere between a buy and a hold. So if you have the stock now, you should hold it. If you don't, you should consider buying it. One thing interesting about Airbnb, expectations are still forming, but the first recommendation that has come out so far in January is to consider selling the stock. And that usually happens when the stock price starts to get very high. Individuals will start to expect, or analysts will start to expect, a correction downwards. So we have about 10 minutes left. So I'm going to turn it over to Amanda. If there are any questions that I could help answer, that would be great. And I'll stop sharing my slides.
Thanks, Nerissa. Really appreciate all of your great insights today. We do have some wonderful questions from our audience. So I'll dive into a few of those. And if people have questions that are still coming in, we'll try to get to as many as we can. So trying to organize these a little bit topically, I want to go back to some of your comments about SPACs, about these blank check companies. So you answered some of these questions throughout your presentation, so I'll try to sort those out. But one question that came up is, what if the SPAC company, right, doesn't end up acquiring a private company in the future, right? Like if they don't follow that model, that's kind of what they're expected to do. How does that change what the outlook looks like?
So good question. And this is something that's still kind of being discussed. So what happens to that entity? Let's say after 2 years, they still don't find a company that's lucrative enough to purchase. The SEC has given, I would say, the green light for these SPACs to be funded by hedge funds. So at some point, usually there is like a 2-year limit. And so if nothing happens with that cash, it might potentially be diverted elsewhere by these funds.
I think you talked about this a little bit in your presentation, but can you comment again on what the increase in SPAC IPOs means, or what it's telling us about the market, and if there are any indications that we can glean from this influx?
Well, one indication that's being discussed in the business press is again the fact that if you think about the top 1% of the population, or the top 5%, there is cash out there looking for ways to invest that cash to generate a return. So, the investors and the hedge funds that do put their money into these SPACs, research has shown, and also, evidence from the business press, that they do make a return once they make that private acquisition or merger. They make their return and then they exit. But then it's the investors that tend to stay in and try to earn maybe a little bit more return after. Those are the ones that end up getting hurt. So, but for the big guys, they know what they're doing. They know that they can purchase a smaller company, make a quick return, and then, they exit, they sell their shares. And so they do benefit. Now, one indication that it's telling us, as I noted before, the fact that a lot of these just kind of went through in 2020, even though we had quite a few, very high volume of traditional IPOs that did go did go live, notice that a lot of them went live kind of later in the year. So again, it's that search for investment vehicles.
Thanks. On the same, related to trends, shifting a little bit away from SPACs, but related to cash flow negative firms who have gone to IPO in the last years. Is this indicating that the market's overhyped? Is it an indication of something else from your perspective? Can we read into that in any way?
Yeah, that's kind of one neat thing about, studying more about IPOs. Most IPO companies are loss generators. And so when you see these high stock prices of like, $100 or $192 per share, it also always leads you to the question of, okay, what are investors seeing? For these IPOs, really what investors pay attention is not necessarily income, but revenue, the ability to generate cash, the ability to generate revenue, because these companies are still in the early growth phase. They are taking that revenue and investing back into the business, into their operations. So eventually they will turn profitable. However, sometimes we just never know when. But if you look at an entity like Amazon that for years never turned a profit, and look at Amazon today, with these IPOs, the message is look at how the company is performing, look beyond the financials, look at revenues, look at how they're generating cash, look at the risk factors, and then form an expectation to say, will this company be profitable in the really longer term? As for investors like us, we kind of would have to be in it for the long haul.
Thanks, Nerissa. And it's great to hear you comment on the impact of researching this over the long period and help distill your knowledge to all of us. So thanks so much for that. One last question, and there were a couple of questions in the Q&A about this topic, but it's around this idea of individual investors pushing up stock prices via social platform discussion. One of the companies referenced was GameStop and what's currently happening with their stock price. So maybe we can close out with your comments on that, and then if you have any final closing remarks as well.
Yeah, and that's kind of an interesting thing that we saw in 2020. There are social media platforms such as stock tweets, Twitter, a lot of entities can, get hype on social media platforms as well. In 2020, we saw the huge, emergence of Robinhood, which is a day trading platform that you can trade stocks on your phone. Day traders were picking up stocks pretty cheap, especially like airline stocks, stocks that were still hurt by the pandemic, but then you can buy them cheap now. However, there's been some issues with Robinhood itself as a trading platform because, when novice investors start trading and again, getting too much in that hype and not paying attention to the financials, to risk factors, etc. And then when, the stock price continues downwards or they don't generate a return, then that's where things can get problematic. So in some ways, don't believe the hype always. And that's why financial statements and financial reports exist as support that if you want to learn a little bit more about the stock and its viability financially, then, turn to that to help you kind of make your decisions. And that's why we have analysts out there, doing that work in kind of giving us expectations about an entity. They do the hard work in reading the financial reports and, putting out information that we as regular investors can easily digest.
Well, thank you, Nerissa. It's been great to spend this time with you. We really appreciate all of your great insights. I also want to thank our participants for attending this webinar and bringing some great questions to the table. We hope you gained some valuable knowledge, and we hope you'll join us for our upcoming webinar on Thursday, April 29th with Professor Elizabeth Lechman. Thanks again, Nerissa, and we look forward to seeing those of you on the webinar back again in the future.
Okay. Thank you, guys.
Bye, Nerissa.
Bye.